It starts with a headline. A company is valued at $63 billion, yet it sells almost nothing. No products, no profits, just ideas, promises, and a lot of hype. And somehow the world believes it. Investors rush in, stock prices soar, analysts cheer. Meanwhile, the actual cash flow is minimal, tiny, almost irrelevant. How does this happen? How can a company be worth billions while selling almost nothing? This is not a story about a scam, not entirely. It's a story about how modern finance, perception, and human psychology combine to create wealth that seems almost invisible. And it's happening right now. To understand it, we have to strip the story down to its bones. No jargon, no textbooks, just the mechanics, plain and simple. Let's start with a basic fact. A company's value isn't always its revenue. It's not just the money coming in. Value is what someone else is willing to pay for it. Yes, that's it. If investors collectively decide a company is worth $63 billion, it is. Not because it earned $63 billion, but because confidence and expectation say it is. This is where things get uncomfortable. It means wealth can exist largely in numbers, not in cash or products. A company can be valuable even if it barely produces anything real. Sounds absurd, almost like magic, but it's real, and it's how modern markets work. Now, here's the first mechanism behind the illusion: expectation of growth. Investors are betting on the future, not the present. If a startup promises that one day millions of people will buy its product, or that it will dominate an entire industry, investors attach enormous value to that potential, even if the company today is barely making a dollar. This is why companies can operate at huge losses for years while their stock price climbs. Think of it like betting on a sports team that hasn't won a game yet, but everyone is convinced it will be a champion next season. The game hasn't been played, the trophy hasn't been won, yet people trade tickets at astronomical prices. That's the first trick. Future expectation becomes present value. The second mechanism is market psychology. Humans are wired to follow trends. If the stock price goes up, more people buy. Fear of missing out kicks in. Suddenly, the valuation grows faster than reality. Even small sales, small announcements, tiny updates can cause massive jumps in perceived worth. A simple press release about a partnership can spike stock price by billions in market capitalization. Meanwhile, actual revenue barely budges. And here's the quiet humor. The wealth exists mostly on paper. The executives and early investors are rich in numbers, not actual cash. They can convert it to money only if someone else buys their shares. The value is social. It's collective belief. Now, let's dig deeper into the financial mechanics. Many of these billion-dollar non-companies survive on investment rounds, venture capital, and debt. Investors inject money. The company burns it fast, hiring talent, buying attention, expanding operations, but often without producing traditional profits. Cash flow is secondary. What matters is metrics that signal growth: users, engagement, potential market share. These metrics are intangible. They're hard to measure, yet they shape valuation more than revenue does. For example, a company may report millions of users, but they may not be paying anything. Yet investors treat this as a guarantee of future profits. This is where the system feels strange. Money flows in because people believe money will flow out later, not because it is flowing in now. Here comes the uncomfortable math. Suppose a company raises $1 billion in funding at a $10 billion valuation. That means investors collectively agree the company is worth 10 times the new money invested. Now the company launches a new round. Maybe it raises $2 billion at $20 billion. Its real earnings may still be near zero, but its valuation doubled. And suddenly, early investors gain billions on paper.
all without a single new customer paying for a product. This isn't illegal, it's not a scam. It's structured finance and investor psychology at scale. The key here is liquidity. Public and private markets allow shares to be bought, sold, and priced continuously. When confidence is high, prices inflate. When fear returns, prices can collapse, sometimes overnight. Now let's zoom out. Why does this matter beyond Wall Street? Because billions in perceived wealth can affect real economies. Executives with billions on paper spend lavishly. Markets react. Governments monitor market caps. Even ordinary people feel it. Stock ownership, retirement funds, and even cryptocurrencies are affected by this perception-driven economy. The illusion of wealth can drive real-world decisions: hiring, borrowing, expansion, and investment. Yet the foundation is delicate: confidence, expectations, perception. If trust falters, the entire valuation can drop like a house of cards. Here's the irony. Companies worth billions with almost no profits are often described as innovative. They're celebrated as disruptors. But their value relies on one simple truth: other people's belief in future success. No products, no profits, no guarantees, just a collective bet. And the risk is asymmetric. Investors who get in early may cash out. Executives may convert options to money. Ordinary shareholders, late to the game, may lose everything. The system rewards access and timing over fundamentals. Let's examine a real-world example, without naming names.
A company launches a revolutionary service. Users sign up. Investors pour money. Media hyped it. Stock climbs from $20 to $200 per share in months. Meanwhile, revenue is tiny. No one is turning a profit. Yet on paper, the company is worth tens of billions. Early insiders sell some shares, capturing billions. Late investors hold paper wealth that can evaporate in a heartbeat. This is the engine behind many tech bubbles. The pattern repeats: hype, investment, inflated valuation, eventual correction. Now, why do markets tolerate this? Because the promise of growth keeps the ecosystem running. Venture capital, IPOs, stock trading, all of it depends on investors believing that tomorrow will be bigger than today. This is why paper wealth can feel real. It is leveraged into real-world influence, hiring, acquisitions, and strategic moves. Yet it remains fragile. And here's the quiet danger. When a company becomes too big to fail on perception, the system bends to protect it. Central banks, regulators, and institutions intervene. Investors pour more money, stock prices stabilize, and the cycle continues. The market is no longer valuing products, it's valuing confidence, access, and momentum. Small errors, scandals, or shifts in sentiment can erase billions overnight. Wealth that seemed untouchable can vanish faster than anyone expected. Now step back and think about the broader implication. If value can exist largely as numbers and expectation, what does that mean for our understanding of the economy? It means traditional metrics, revenue, profit, cash flow, are no longer the sole markers of worth. It also means the public, whose retirement accounts may be invested in these companies, is indirectly betting on belief, not reality. And that is both fascinating and risky. Here's the final uncomfortable truth. A company can be worth billions without selling real products because expectation drives valuation more than revenue. Human psychology inflates numbers through hype and momentum. Financial mechanics allow early investors to profit, even when cash flow is minimal. Confidence becomes currency. The wealth is real for those who control it, but it exists on the edge of reality. A single change in belief can make billions disappear. Yet the system keeps repeating itself. Because as long as people believe in growth, innovation, and the next big thing, the market will assign value to ideas and promises, sometimes far beyond what is actually produced. So the next time you hear about a startup worth tens of billions, pause. Ask yourself, how much of that value is actual revenue? How much is confidence? Who benefits if the bubble continues? Who loses if it bursts? The answers aren't comfortable, they aren't neat, but they reveal the quiet engine of modern finance, a system that can create billions from almost nothing. And that engine isn't going anywhere until it finally reaches its limit, until the world decides to measure reality over expectation, until belief alone is no longer enough. And that's the real story behind billions on paper, companies that sell almost nothing, and the fragile, invisible power of confidence in the modern economy.